Lab. I'm Daniel.
And I'm Mira.
And wow, overnight, this fragile geopolitical ceasefire just completely collapsed. I mean, it sent crude oil spiking over $4 a barrel. And, that was just the baseline we woke up to today.
Yeah, just the starting point.
Right, because before the closing bell even rang, tech traders were put through this heart-stopping 650-point intraday plunge in the Nasdaq, only to witness this massive, almost logic-defying late-day rescue. I mean, if you were watching the tape today, July 8th, 2026, you probably have financial whiplash.
You absolutely do. I mean, it was an exhausting session just to watch, let alone actually trade.
Yeah.
So the mission of this deep dive into today's market sources is to untangle exactly how the market digested these sudden energy shocks alongside some very sticky inflation fears. We're going to unpack the mechanics of that massive tech sell-off, the underlying strength that somehow brought it back from the brink, and what this extreme volatility means for the days ahead.
Exactly. And before we jump into the deep end, just a quick reminder, this show is strictly for market context and discussion.
Right.
It's not personal investment advice or, an investment recommendation. Always keep your own risk profile in mind.
Definitely. So, I mean, the sparks for today's market firestorm, they actually started flying before the U.S. even woke up.
What set the stage before the U.S. session?
Well, to understand the sheer defensive posture of the cash open, we really have to look at the overnight carryover from late yesterday, July 7th.
Right. The Middle East news.
Exactly. At roughly 5:15 p.m. Eastern Time, the U.S. military launched intense retaliatory strikes against over 80 Iranian targets. And this was a direct response to recent Iranian attacks on commercial vessels navigating the Strait of Hormuz.
And for anyone tracking global supply chains, I mean, the Strait of Hormuz is essentially the jugular of global energy.
It really is.
We're talking at a choke point where a fifth of the world's petroleum liquids and, a massive share of liquefied natural gas pass through. So when things escalate there, the entire global economy immediately feels it.
Yeah, and the reaction was incredibly swift. Iran retaliated against U.S. military bases in Bahrain and Kuwait.
Wow.
And following that, President Trump declared the interim ceasefire, which, by the way, equity markets have been leaning on heavily over the last few weeks. He declared it effectively over.
Sure is done.
Done. And he went a step further, openly threatening a blockade on Iranian shipping, which includes highly sensitive infrastructure like Karg Island.
It's always so tempting to look at these massive geopolitical flare-ups like they're unpredictable natural disasters. We tend to view them the same way we view like a Category 5 hurricane hitting an offshore oil rig, just a random catastrophic event.
But that's a reflex that is really worth challenging.
How so?
Because if we examine this through a game theoretic lens, we shouldn't view these strikes as just random lashouts. What we're actually looking at is geopolitical coercion as bargaining leverage. Both state actors are actively signaling their pain thresholds in a highly vital economic choke point. By escalating, they're trying to establish the new rules of engagement, to gain maximum leverage for future negotiations.
That makes sense.
And the market doesn't like uncertainty, obviously.
Yeah.
But it particularly hates when bargaining leverage involves restricting 20% of the world's oil supply.
Yeah, I'd say so. And the energy supply shock wasn't just limited to the Middle East either.
Sure, it wasn't.
Because around 11 a.m. Eastern time today, so that's 8 a.m. Pacific, Russia's deputy prime minister announced a strict ban on diesel exports.
Right.
And this announcement came directly after Ukrainian drones managed to knock out Russia's largest oil refinery in Omsk.
Which is huge, because diesel is the lifeblood of physical goods movement.
Right. Trucks, trains.
Exactly. Freight trains, agricultural tractors. When you remove Russian diesel from the global market entirely, you aren't just raising the cost of a summer road trip. You're applying this immediate, unavoidable tax on global logistics and food production. So you have two parallel energy shocks, crude out of the Middle East and diesel out of Russia, hitting the global supply chain simultaneously.
And somehow, the macroeconomic headwinds didn't even stop at the energy sector. European markets were already getting hammered early in the morning.
Oh, yeah.
Because at 4:08 a.m. Eastern Time, President Trump ordered a total trade cutoff and a bilateral visit halt with Spain.
Which is just, the chilling effect of a sudden trade cutoff with a major European economy cannot be overstated.
No.
It forces multinational corporations to immediately pause operations, reassess their supply chains, and, worry about retaliatory tariffs.
Right.
And that uncertainty pushed the SIOXX Europe 600 index down 1.61% right out of the gate. When the European Commission actually had to step in publicly and urge the U.S. to honor existing trade deals.
Which really just highlights the fragility of the whole situation. Yeah. And adding to that overall economic gloom, at 9 a.m. Eastern time, the International Monetary Fund dropped a really heavy report. They downgraded their 2026 global economic growth forecast from 3.1% down to 3.0%, while simultaneously raising their global inflation projections.
Yeah, and that combination right there is the classic recipe for stagflation anxiety.
Slower growth, higher prices.
Exactly. Slower economic growth combined with stickier, higher prices.
Yeah.
The IMF explicitly noted that the global disinflation trend, that narrative that prices were finally cooling off, it's completely stalled.
Wow.
And the primary culprit, energy prices.
Yeah.
Which are now roughly 25% higher than they were before this Middle East conflict escalated.
So the U.S. equities market opens up, and it's inheriting this deeply defensive, inflation-spooked global backdrop. I mean, we've got collapsing ceasefires, strict export bans, sudden trade wars, and global growth downgrades all colliding on the exact same morning. And that cocktail of anxiety, it resulted in an absolute intraday roller coaster. So we're going to take a short break, and when we come back, we'll uncover exactly how U.S. markets reacted upon opening.
Welcome back. So what moved markets during U.S. trading hours?
Well, the tape today was just historic. During the midday sell-off, the S&P 500 tumbled to an intraday low of $7,468.50.
Brutal.
Yeah, and the VIX, the fear gauge, it spiked up near 19, and the tech sector really took the brunt of it. Nasdaq futures collapsed roughly 650 points from their overnight highs.
Yeah, and to understand why the bottom fell out so aggressively around midday, we really have to unpack the mechanics of the bond market.
Right, the auction.
Exactly. The turning point crystallized around the 1 p.m. Eastern Time U.S. Treasury auction. The Treasury was attempting to sell $39 billion in 10-year notes, and the auction was undeniably weak. I mean, it cleared at a high yield of 4.58%.
So a weak auction basically means the government had to offer a higher interest rate just to attract enough buyers to take down that $39 billion in debt.
Precisely. Investors are essentially saying, hey, given the geopolitical chaos and the rising inflation forecasts, we demand more compensation to hold long-term U.S. debt.
Right. And this is really where the concept of discount rates as valuation gravity comes into play, especially for these high-duration equities.
Yeah.
Because when we talk about high-duration equities, we mean these massive tech and AI companies whose expected profits are, years or even decades down the road.
Right. So think of the 10-year Treasury yield as gravity for stock prices. When you can get a guaranteed risk-free return of 4.58% from the U.S. government, you become much less willing to pay a premium for a tech stock whose profits are theoretical and years away.
Exactly.
As that yield spikes, the valuation multiples of those tech stocks compress. That 4.58% yield was really the catalyst that triggered the massive algorithmic selling in the Nasdaq.
And then, just an hour after that messy auction at 2 p.m. Eastern Time, the market gets the release of the June Federal Reserve meeting minutes. And if traders were looking for comfort there, they definitely didn't find any.
No, not at all. The officials were unanimous on holding interest rates steady, but the underlying commentary was highly concerning.
Very hawkish.
Right. The Fed noted that massive AI-related energy demand, the ongoing Middle East hostilities, and new trade tariffs are all working in tandem to keep inflation elevated.
Yeah.
And the situation is so sticky that Fed staff actually went so far as to revise their 2026 and 2027 inflation forecasts higher.
Right. So the minutes clearly reflected a fear of an inflation expectations as self-fulfilling spiral.
Yeah.
That idea that if businesses and consumers believe inflation will stay high, they raise prices and demand higher wages, which in turn actually causes inflation to stay high.
It is the central bank's absolute worst nightmare.
It is. But here's where I want to push back on the prevailing narrative a bit, though.
Okay, go ahead.
The Fed minutes were undeniably hawkish, right? And the Treasury auction was weak. But look at what actually happened in the final hours of trading today. We saw a heroic late-day rescue.
We really did.
Buyers stepped in aggressively. They allowed the S&P 500 cash index to claw its way back to close down just slightly at 7,482.71. And Nasdaq futures. they managed to erase almost all of that 650-point deficit to settle nearly flat.
It's a striking reversal for sure.
Right. So doesn't that suggest that these rearview mirror Fed fears are already fully priced in by investors? I mean, I'd argue that the massive intraday recovery proves buyers are essentially ignoring the Fed's historical anxiety.
Right, looking past it.
Yeah, they saw a 650-point dip in the Nasdaq, and they treated it as a buying opportunity, completely brushing off that 4.58% yield.
Well, the market is fundamentally a forward-looking discounting mechanism. While the yield spike in Fed fears definitely broke the market's back momentarily around midday, that underlying demand for U.S. equities just refused to capitulate. Institutional investors might just be deciding that the sheer earnings growth of these mega-cap tech companies can simply outpace the drag of a 4.5% interest rate.
Yeah.
They're betting that the corporate fundamentals are stronger than the macroeconomic headwinds.
Right. Well, to sum it up, while yields spiked and Fed fears definitely peaked midday, the underlying demand kept the market from fully breaking. So we're going to take another quick break, and when we come back, we'll dive straight into today's corporate developments.
Sounds good.
All right. Welcome back. So what are the key corporate events from today, and what should we watch next? Because speaking of those corporate fundamentals, the sheer scale of the capital being deployed in the tech sector right now is staggering.
It's unbelievable.
Yeah, let's look at the key corporate events from today because they perfectly illustrate why the market is so willing to buy the dip. At 6 a.m. Eastern Time, Apple announced it's expanding its partnership with Broadcom in a deal worth over $30 billion.
Yeah, this is a huge multi-year agreement that secures custom silicon and wireless connectivity components all the way through 2031.
$30 billion for physical components. I mean, this completely cements the reality of AI CapEx as an Adam's bottleneck.
Absolutely.
We spend so much time talking about software, large language models, and cloud computing. But at the end of the day, you need the physical infrastructure. The atoms, the custom silicon chips, the fiber optic cables, the actual server racks to run these models.
Right.
You literally cannot code your way out of a physical hardware shortage.
You can't. And securing that physical hardware requires an unbelievable amount of energy and real estate, which actually brings us to Meta's announcement today.
Oh, right.
At 3:30 p.m. Eastern Time, Meta announced a strategic pivot, shifting its massive $10 billion AI data center build-out to Louisiana, basically abandoning its original plans in Canada.
And the real story there is likely power access, right?
Exactly.
Because these hyperscaler data centers draw the same amount of electricity as small cities. You have to build them where the grid can actually support them. But funding these massive physical infrastructure demands, $30 billion for Apple, $10 billion for Meta that requires immense liquidity. We're seeing incredible moves in the corporate debt markets to fuel this race.
Yeah, just look at late yesterday. At 5:30 p.m. Eastern Time, Amazon priced a massive $24 billion multi-tranche debt offering.
Wow.
And a multi-tranche offering just means they're borrowing money across different time frames, some 3-year debt, some 10-year debt, some 30-year debt to spread out their repayment risk. But they are literally raising tens of billions of dollars in the bond market just to keep pace with the capital requirements of building out their AI infrastructure.
And if we connect Amazon's debt offering to the bigger picture we discussed earlier, it perfectly explains why the Treasury auction struggled today.
It really does.
You have Amazon borrowing $24 billion from the market. You have the U.S. government trying to borrow $39 billion. There is this massive, aggressive competition for capital right now between sovereign governments and mega-cap tech companies.
And meanwhile, the regulatory landscape for these tech companies is shifting just as fast as their hardware requirements.
True.
We had a major late-night regulatory development on July 7th at 11:13 p.m. Eastern Time. The U.S. Commerce Department formally approved OpenAI's wide public release of its GPT 5.6 models.
Which is just a massive green light for the AI sector. The fact that the Commerce Department had to approve it highlights the national security implications of these models, but passing that hurdle just clears the runway for deployment.
It does. But while foundation models like GPT 5.6 grabbing regulatory approval make for great headlines, the underlying structural trend in the industry is really vertical integration to avoid AI tolling.
Actually, can you explain how that tolling mechanism works?
Sure. So right now, many companies build their applications on top of models like GPT 5.6, meaning they have to pay OpenAI a quote-unquote toll usually a tiny fee for every single prompt or API call their users make.
Right, per usage.
Exactly. And at a small scale, that's fine. But at an enterprise scale, those tolls utterly destroy your profit margins. So to protect their margins, companies like Microsoft and Meta are vertically integrating. They're spending billions to develop and run their own in-house AI models so they don't have to pay licensing tolls to third-party developers.
Oh, nice.
It fundamentally changes the long-term margin math for the entire software sector.
You know, if today's market roller coaster gave you whiplash, don't worry. The Commerce Department just approved OpenAI's GPT 5.6, so we can finally outsource our panic to an AI.
Right.
Because Nasdaq futures plummeted nearly 650 points before miraculously clawing all the way back, meaning the only thing more volatile than the Strait of Hormuz today was the average tech trader's heart rate. At least crude oil rose over $4, giving us a great excuse for why our portfolios are currently running on empty. So pour yourself a drink, celebrate surviving this wild trading session, and let's hope tomorrow's jobless claims don't require us to file our own.
I think the entire trading floor needs a drink after that session. But, the day doesn't stop.
Never does.
Looking ahead to tomorrow, Thursday, July 9th, here are the key events you need to monitor. At 8:30 a.m. Eastern Time, the U.S. weekly jobless claims report hits the wire. After the Fed cited inflation concerns today, any sign of a tight labor market will likely send yields higher again.
Right.
At 9 a.m. Eastern Time, New York Fed President John Williams gives a speech. Listen closely for any commentary on today's messy Treasury auction.
Definitely.
Then at 10 a.m. Eastern Time, U.S. existing home sales data for June drops, giving us a read on how mortgage rates are impacting housing turnover. At 11:30 a.m. Eastern Time, the Treasury is back at it with 4-week and 8-week bill auctions. And finally, at 1 p.m. Eastern Time, watch the U.S. 30-year Treasury bond auction very closely. Because if the 10-year auction struggled today, the 30-year auction tomorrow will be the ultimate test of long-term bond demand.